Hello and welcome back to Dukascopy TV. Dollar pairs are featuring today on Targets in Focus, and by that I mean the US dollar. Joining me on the line from London is the head of FX strategy at Canada International Bank of Commerce, Jeremy Stretch. Jeremy, thanks for joining me today. We'll start with the euro. It managed to regain the key level at 129 today after dipping to fresh lows around 128.80. Italian GDP figures for the first quarter came in short of expectations following same data from Germany and France. Heavy sentiment on the euro still, do you think?
I think when we're considering our outlook for Europe and the Eurozone, I think we need to consider the backdrop for the Eurozone economy provided by those GDP numbers and expectations, because I think what we have to recognize is that we are in the process of seeing 6 straight quarters of negative growth for the Eurozone, and even the previous motor of growth for Europe, the German economy, is also struggling somewhat, with the first quarter revealing just a 0.1% quarter-on-quarter gain. And I think it's very interesting if you drill down within that to try and sort of extract some of the details for that underperformance in Germany, and you find that there is no real contribution from net trade. And that just underlines the fact that the German economy is facing increasing difficulties in terms of competitiveness compared to someone like Japan because of the rapid appreciation of the yen. And it just underlines the difficulties that the Eurozone continues to face from a macro perspective, as well as obviously the influences that has on the monetary policy debate. And I think the onus is increasingly large on the latest or the upcoming flash PMIs later this month on the 23rd, because if there is no sign of any recovery in some of those indices, then I think the ECB staff forecast will be revised down for the June ECB meeting, and that will put further pressure on the ECB to continue to ease policy. And I think as an ongoing byproduct of that, what we are seeing is that the prospect of the US continuing to maintain a steady recovery process, as well as seeing a better fiscal backdrop, which contrasts obviously with the Eurozone, the prospect of the ECB being forced to consider further easier monetary policy underlines our broad-based perspective of seeing a weaker euro through the course of not just the 1 month, but also through the 6 months, as we do see the prospect of euro-dollar heading back towards what we would consider to be sort of fair value levels. And that's fair value for the Eurozone as a whole at around 123, 124. But of course, for the Eurozone, in terms of the peripheral economies, they would probably prefer a much weaker euro. But I think that's probably as much as we can actually anticipate in the short to medium term.
Let's move on to the Australian dollar. Some analysts are warning of corrective rebounds taking place against the US dollar. Do you agree with this?
Well, I think we've obviously moved a relatively considerable distance relatively quickly, and that always does provide some scope for a corrective bounce or a corrective rally. I think what I would be mindful of is that if you look at the underlying dynamics which have been hitherto supportive for Australia, those supportive factors have been gradually dropping away, and of course in the context that is the commodity space via the leverage of the China growth story. Well, that's looking much less robust. The fiscal backdrop, as demonstrated by Treasurer Swan this week in the pre-election budget, certainly is far less encouraging than the government were portraying, certainly as recently as 7 months ago, when they're expecting a small surplus for this fiscal year rather than the more than $19 billion of deficit. So I think those two factors are certainly mindful of ongoing weakness in the Australian dollar. And I think also we need to consider what the monetary policy backdrop is likely to portray for Australia going forward, because of course, much like the majority of global central banks have been either increasing their balance sheets, the RBA has obviously eased monetary policy to a fresh record low earlier this month. Whilst it may seem a little ambitious to expect another rate cut to come as early as the June 4th meeting, if we were to see further falls or weakness in capital investment and capital expenditure in the first quarter, when we get that data at the end of this month, then I think the markets will continue to price in the prospect of further easing from the RBA to offset what is still or what is a less than constructive fiscal backdrop. And so that sort of constructive bias, or the risks of a rebound in the Aussie, I think should be kept in that context. So I think near-term, short-term rallies are probably still opportunities to fade, and I think still realistically we're going to be testing those lows from last year at 96 rather than necessarily looking for moves back above parity.
Finally, positive jobs data from the UK gave the pound a boost against the dollar today, but sterling hasn't been faring well at all recently. Will this mark a change, do you think?
Well, it's kind of interesting that obviously, fairly recently, earlier in the month, we were trading up north of 156, and we've seen a fairly substantive rebound. And yet, at the same time as we've seen that weakening off in sterling against the dollar, we've actually seen data flow, which in the main has been relatively more constructive. And I think we'd probably almost argue that the economic glass in the UK is probably increasingly half full, and maybe a little bit more than half full. Certainly, the tone of the outgoing Bank of England Governor Mervyn King at the quarterly inflation report was certainly more upbeat than I can recollect, certainly since the advent of the crisis. So it's rather perverse that obviously sterling has been weakening, but I think what we are seeing is that sterling generally tends to struggle, and certainly against the dollar, in the midst of what is considered to be event risk. And I think there are a couple of significant event risks which are continuing to overlay sterling. One is, of course, the transition in the monetary policy regime as Mark Carney arrives from the Bank of Canada on the 1st of July. And I think there is still the suspicion that he will have a much more creative and or expansionary monetary policy backdrop, which will encourage a weakening in sterling. And also, I think the ongoing debates internally in the UK regarding its relationship with the European Union and the increasingly fractious relations between the governing coalition are also likely to weigh on sterling somewhat, and political uncertainty is generally reflected in sterling against the dollar. And when you overlay those two sort of domestic factors, which probably are overshadowing the moderate improvement in the economic data, and you contrast those with the improving sentiment that we're seeing in the US and the rising or move in bond spreads, then that's underlining that sterling is looking set to test back through the bottom of what I would consider to be the 150-160 fair value range. Cable sterling against dollar in that range is probably fairly valued. Periods outside it normally are relatively transitory and short-lived and are either buying or selling opportunities depending on which side of the equation you're in. I think we may well find ourselves within the next 3 months or so having another look down towards the cyclical lows, sub 149, but I think that will probably provide some better levels to start to reconsider some sterling positions into the back end of this year. But in the near term, I think we will continue to see sterling underperforming.
Okay, thanks for joining me today. Jeremy Stretch there, Head of Forex Strategy at Canada Bank of International Commerce. That's all we've got time for now. I'll be back tomorrow with the press review. Until then, goodbye.